On today's Hot Sheet, I'm discussing housing inventory, the CoreLogic home equity report, and the jobs report from Friday. Today is Monday, June 10th, 2024. I'm Byron Lazine, and the Hot Sheet starts now. Welcome into a new fresh week here on the Hot Sheet. As we do every single Monday, we will kick off this week with an inventory update. The numbers are interesting. It's different from the last few weeks, and I'll explain. Also, the home equity report I found fascinating, as well as Friday's jobs report and what that might mean for rates. Before we dive in, let me know which market you're tuning in live from. I'm back up in my Connecticut studio, where I'll be for the majority of the summer. Looking forward to see where you guys are tuning in from here as we go and close out the second quarter of the year here over the next couple of weeks. All right, let's dive right into it. We've got our Altos Research inventory update for the week ending of June 7th. Okay. So the week ending June 7th, we saw inventory rise. So we're continuing to see this trend of inventory going up, but it didn't go up as much as we've seen in recent weeks. We didn't see it go flat, but we only saw it go up about 6,000 plus, from 604,000 to 611,000, basically 605 to 611.5. Where last year at this time we were sitting at 443,000, we're now into the 600,000s. This would be obviously a peak for any time in the last 3+ years. We're 32% more than last year. But if we compare it to what I consider a normal market, a pretty strong normal market, 2019, we would see that in 2019 we were at 900 and just about 950,000 in week 2 of June for active inventory, single family inventory, active listings. Obviously 611 to 950 is quite a ways apart. But we're going to be passing here 2020, which obviously 2020 was on its downslide the end of last year, or the end of that year. We're going to be passing 2020 here pretty soon, and we will now have more inventory once we do at that time in 2020, 2021, 2022, and 2023. And we're potentially going to start to gain on 17, 18, and 19 numbers, where they ended the year, somewhere in this fall. If we continue on this trajectory, we could potentially encroach on 800,000 active listings. It obviously remains to be seen heading into an election cycle in November, how many people are going to keep their house on the market through then, or are we going to see homes coming off the market earlier? If we look at trends in normal markets, you start to see these homes coming off the market by the end of October, and then November and December, they start to decline, where in recent years, 2022, 2023, you didn't start to see it happen until December. So we grew inventory 22 and 23 through October and really even into November, where it flattened out before taking that seasonal decline in December. So will 24 look more like 22 and 23, or will we go back to what we saw in 17, 18, and 19 in a more normal market, where you'd start to decline in November? Okay. It'll be interesting to see what happens this year with the dynamic in November, obviously, and then you started to get into the holiday and seasonality timeframe when you would normally see homes in winter just coming off the market. So we got our bump in inventory, not where we want it to be, which is double digits. 10 to 17,000 is the Logan Motoshami number that he's looking at very closely. But we did see a gain, and we're consistently gaining here throughout the year. Again, peak level for the last 3+ years, 32% more than last year on active listings. Now, new listings continuing to tell the same story right now here, according to this Altos research. New listing data for last week was above 2023, but that's not really a win. 2023 was the all-time low for new listings and still below 2022. And that's really the trend we've seen here for the majority of the last 2 to 2.5 months, where we've been above all-time low levels of 22 or 23 rather, but we haven't been above 2023 new listing levels. So a gain on new listings, 72,000 for last week, but still not what we saw in 22 of 85,000. Okay. Um, it's interesting because we're not getting as many new listings as we did in 22, but yet we're accumulating active inventory at a much higher level than what we were in 2022. Even when 2022, when we saw these interest rates shoot up, this is that sharp increase right here. Still, at no point in 2022 did we have as much inventory as we have today as we sit here in the middle of June, which will not be our inventory peak. Reason for that, okay, we were getting more new listings in 22, but we were coming off of all-time low inventory, and also homes aren't selling in the same fashion in 24 as they did in 22. We had much more existing home sales in 22. We don't have that kind of demand, not from a mortgage perspective or from a pending home sale perspective. When we look at the mortgage purchase application index, you see here that where we are, which has been on a decline here since. I mean, if you consider what really is a decline, I mean, we've been on a decline on mortgage applications really just all year since February. I mean, we've had some valleys that have popped back up, but this thing has just been riding down or flat all year. This is below 2023 and 2022 levels. For anybody to say that we have demand similar to the last 3 years, not in the next 60 to 90 days. Okay, be honest, be truthful. We don't have that kind of demand, and this chart is a picture of that. We do have pent up demand in the future. Like last week, we went out on how many of these generations want to buy and have a desire to be a homeowner. Not the case in the next 60 to 90 days based off of affordability and obviously other issues, right? We're also not seeing the level of pending sales that we saw in 2022. Heck, we're getting close to dipping below 2023 pending sale data, which was almost unthinkable coming into this year. Pending home sales much higher in 2022. Now they took a sharp decline towards the end of the year, but we're on the way down right now on pending home sales. We took a look at NAR's updates. So that demand just isn't there. This housing recession continues. Housing recession meaning lack of sales, not necessarily lack of equity, which we're going to get into here in just a second. Quick update on price reductions. We've now gone to 36%. Remember, normal markets is experiencing 33%. We're above 2022 and 2023 levels on price reduction, sitting here at 36% of homes experience a price reduction before selling currently in this market. Okay. Equity is one thing that has not been impacted despite being in a real estate recession. CoreLogic just came out with data through Q1 of 2024 highlighting these facts. We have a 9.6% increase year over year from the end of Q1 in 23 to the end of Q1 in 24 on homeowner equity. That's up $1.5 trillion. That's a lot of unrealized cash for homeowners. They're in a very strong position. Nobody would have to fire sale their house. They're not underwater like they were in 2007 and 8. This is a much different market than we were experiencing there. 9.6% equity is high. This is one of the benefits. This is one of the true benefits. This number, I think, is a good way to highlight to home buyers what the what the value in buying over renting is. Okay. We saw a 6+% quarter over quarter, according to Case Shiller, on home values. Okay. Home values. So 6+% on the value, yet homeowner equity goes up 9.6%. Because at the same time your home is appreciating, homeowners are paying down that debt. Okay. They have a fixed cost on their mortgage, 30-year fixed, hence the name. But at the same time, they're growing equity or rather appreciation. They're building even more equity than that. That's why the equity is bigger than the appreciation. We all get that. The homes that have negative equity, that underwater, that went down from basically nothing, another 16%. 192,000 homes less have negative equity than they did. And really, the only homes that I would imagine had negative equity before would have been those like late 2000, like early 2023 homes. So these are like newer purchases. But from beginning of 23 to 24, those values go up 6%. It kind of clears the way for a lot of those homes. Okay. The total number of mortgage residential homes with negative equity decreased from last quarter of 23 to quarter 124 by 2.1%, 16.1 or 16% year over year. That number is only 1.8% of mortgaged homes. Okay. So we're not talking about a huge number of homes that have negative equity. On a year-over-year basis, negative equity declined 16% from 1.2 million homes, or 2.1% of all mortgage properties from the first quarter of 23. Based on because home equity is affected by home price changes, borrowers with equity positions near the plus or minus 5% mark we're out of that, because when home prices go up 6+%, it puts them into positive equity time frame. Okay. Or positive equity category. Here's the negative equity numbers by state. Okay. Now, negative equity peaked at 26% of all mortgage properties in the fourth quarter of 2009 after the great financial crisis, based on equity data. So here's one of those charts that shows you how different we are from 2009. This chart here below is negative equity share by U.S. state as of quarter 1, 2024. Remember, 26% in 2009. You've got Florida at 1.1%. Let's pick out some of the big ones that people get concerned with. Florida's at 1.1%. Texas is at 1.7%. California's less than 1%. Okay. You've got in the Northeast, Massachusetts at 1.1%. New York is being labeled as high at 2.8%. So we're labeling that high in today's climate, well off of the 29 or 26% of 2009, rather. Carolinas are 1.6, 1.8. You see Arizona less than 1%. Nevada's less than 1%. It's really the middle of the country there that has higher. Now, we've seen middle of the country, those Midwest states. We've also seen low inventory there. We've seen a competitive market. And so you can imagine that some of these numbers are recent buyers who have had to buy for a premium in those markets. Okay. In the Northeast, New York being the outlier that is high. Really across the entire Eastern Seaboard, you have moderate negative equity share. Out West, you have low to moderate, and it would be primarily the middle of the country. Some of the very high outliers would be Louisiana, and I clearly don't know which state this is, but come on, Haley. All right, Haley's good. First person to name this state gets a cookie. Okay, in the comments, if you could see what I'm circling there, it shows you how dumb I am. Iowa. Okay, there you go. Caitlin Clark territory there. Iowa at 4.8, and Louisiana at 5.7. Those would be the high states with negative equity share. With home prices continuing to reach new highs, owners are also seeing their equity approach the historic peaks of 2023, according to CoreLogic. That's $305,000 per owner on average. 300 plus thousand in equity per owner. Now it's kind of like having a stock. If you own Facebook and you're never going to sell it, you know, you're not really up or down. When the stock goes down, you're not really down. And when the stock goes, like, what's that Warren Buffett line? If I'm not selling, I haven't lost anything. I'm just holding this stock. I'm holding ownership in this company. It's the same thing. It's the same thing here in homeowner equity. Okay, I've got 305,000 equity in my home, but I can't do anything with it if I'm not willing to refi or sell. If I'm not willing to tap in, there's not much I can do with that 305,000, and it could go down. It could go down to 250. Could go back up to 350, 400. Right? If you're not a seller or somebody who's going to finance and leverage that, there's not much use for it other than feeling good about yourself. And there's nothing wrong with feeling good. National homeowner equity here is the equity in the first quarter of 2024. The average U.S. homeowner gained approximately 28,000 in just the first quarter. Here's the average home equity changes by U.S. state year over year. So this is just changes year over year. Some of the big ones would be California, Massachusetts, and Jersey posted the largest national equity gains. Okay. No state saw annual equity losses. Okay. No state, even you, Texas, are in good shape at $1,000 of a gain on equity year over year. So this is the average equity gain year over year. Florida, despite the inventory increases, saw an equity gain of 28,000. Again, California, Massachusetts, and Jersey, all at basically 60,000 or above. You see Maine coming in at 40,000. New York at 24,000. Massachusetts, again, I mentioned Massachusetts, 61,000. So there you go. Nevada at 35,000. And you can see, similar to where we saw the high negative equity, the middle states. Now that I know which state Iowa is, 13,000 gain for Iowa. Okay. On the average, you just see those lower numbers than the orange, which you see on the eastern seaboard, mostly west. Those gray numbers would be your lowest. So even lower than that, which would Louisiana, Texas, and those southern ranges. I would expect that Florida to come down with where inventory is going. I would expect that in Arizona, some of these states where inventory is going up. I'd expect next quarter, maybe 2 quarters from now, these numbers to come down. Certainly when you go year over year, I think some of these numbers on the equity gains will be smaller, maybe still in the positive, but smaller than they are today. Okay. Here are some selected metros. If we're just looking at metros, negative equity has seen a recent decrease across the country. Las Vegas is the least challenged, so they're going back to negative equity. You really see Houston and Chicago and Washington, New York and Boston as being up over 1%. Chicago up over 2.5%, and then percent of homes negative equity for Vegas, San Francisco, LA, and Miami, all under 1%. Loan to value ratio. This chart shows national homeowner equity distribution across multiple LTV segments. These are, by the way, all the charts will be available for you inside of BAMX, along with today's show notes, which are robust. So if you want to use some of the text information in the show notes along with the chart to send out some text messages inside of your database, some emails, some updates in your marketing, go ahead and grab those inside of BAMX. If you are not a BAMX member, use code HOT to get 10% off of BAMX. Of course, all BAMX members get 25% off of BAM Mania, October 18th at Circa Las Vegas. Right now, we are in early bird pricing, and our BAMX members are cashing in on 25% additional off of that early bird pricing. If you haven't taken a look at BAM Mania, obviously the landing page is great. We're announcing more and more speakers, but take a look at Circa Las Vegas, where the venue is. You're going to be blown away by Circa. It's unbelievable venue. All right, what is unbelievable as well is the jobs report that came out on Friday. These numbers beat expectations, not to the negative, but to the positive in a huge way. Now, the expectations were that new jobs would increase by about 190,000. That was the consensus estimate. They came in and just dramatic, shocking increase at 272,000 for the month of May. This exceeded the Dow Jones estimate by 80 plus thousand. It also exceeded April's new job report of 165,000. So all of a sudden we get this boom, this unexpected boom on jobs. Now remember last week, we actually saw the 30-year fixed last week come down to the almost the 7 mark, right? In anticipation of this job report. Then what happened? We saw on Friday when the job report come out that the 10-year popped and the 30-year went back up to 7.15. So this stickiness, this week-to-week data, you know, what it all means. How's the Fed going to look at it? It's Fed week, by the way. We've got an FOMC meeting later on this week. What's it going to mean? This increase in jobs, the Fed doesn't love it. They want to maximize employment, of course, but they want to handle inflation. They want to get it back down to the 2% target. The Fed doesn't believe new hires suits that goal. It was kind of a double-edged sword, though, because while we saw the 272,000 jobs, we also saw unemployment at 4%. So unemployment's been edging up as of late. You know, we were kind of sitting in that 3.8, 3.7 mark there for a while. And now you see unemployment really still very low, but starting to edge up now at 4% on unemployment. So kind of I guess double-edged sword is not the right word. It's kind of like, okay, we got this high increase on jobs. The market's reacted to that. The 10-year still not cooperating with us today, coming in at 4.459. You know, here's the last 5 days on the 10-year. You can just look at the chart. It explains itself. You know, we were kind of cooling down there for a little bit last week in anticipation of a low job number, and then boom, it shoots up. This is right. This sharp increase is right on the new job data, and now it's continued to go up into today. Now the market's kind of saying, what's going to happen here with this FOMC meeting? Is it going to be a hawkish tone? You know, how is the Fed reading into this stuff? And so 4% on unemployment, that could be a positive for us with the Fed, the way they look at it. Jobs report, certainly not one. You could imagine the 30-year fix could tick up a little bit more here today. All right, that's your hot sheet here for today. Please consider subscribing to the channel here. It's right down below. Subscribe, hit the notification bell if you're on YouTube. If you're listening to the replay on Apple or Spotify, love for you to leave us a review there. Hope everybody has a great start to their Monday. We'll see you back here tomorrow, 9:30 on the East, 6:30 on the West. Until then, toodaloo.